Hey everyone, Matthew Holt, Christian Wealth Management, just here with a second quarter update. Want to talk about the stock market, and of course, if we're going to be talking about the stock market, we have to start with the Fed. So the Fed, in case you didn't know, has a dual mandate. Little education piece here. Uh, First and foremost, their job is to maintain price stability, and that has to do with inflation and the cost of goods and services in the economy. But second, it's to maximize employment throughout the economy. Now, they have two main tools that they use to fulfill this mandate. One is adjusting rates using the central bank. Okay, rates can go up or can go down. Obviously, we've been seeing them go up a lot lately. And they also buy and they sell U.S. Treasury debt, and that's called quantitative easing or quantitative tightening, adding or subtracting dollars from the U.S. economy. We just got done with a big cycle of quantitative easing where we had lots of money injected into the economy during COVID. That kind of propped things up while we shut down our businesses. And so that would be a great example of quantitative easing. And now we're kind of going in the opposite direction where that money is starting to be siphoned back out. Now, in the near term, earlier this month, the Fed, as expected, raised rates about 20. They raised rates exactly 25 basis points, but they did signal more recently that that they are nearing the end of their rate hike cycle. Okay, that is actually encouraging news for the stock market. Now, in the long term, the general consensus among the Fed is that rates will ratchet lower over the next 3 years, eventually landing around 2.5% by 2026. Now, we don't know for sure if that's going to happen, but that's what the Fed is saying. That is their expectation. And so I think that's important to know because, again, that could give a lot of confidence toward the stock market. And as long-term investors who don't try to time the market, I think that is probably the most important piece about the Fed, not necessarily what they're doing this month, but that they have an expectation now that inflation is coming down to levels where they feel comfortable reducing those interest rates. And so that's a positive thing, and I hope that it does happen. So the stock market, let's talk near term about the market. There's still a lot of uncertainty out there, so much so that a lot of investment dollars have flowed to mega cap companies like Google and Apple, and there's a few other mostly technology companies. And this is where money is kind of hanging out because they're big, stable companies. They don't have as much of the price fluctuation as a lot of the smaller companies out there. And so subsequently, the smaller companies have gotten hit and they've gotten hurt pretty bad. Mid-sized companies have also gotten hit, not as bad as the small. And then even large companies have seen some downward trends this year. And all of this, kind of in the midst of trying to recover from last year, which was, a year of loss for the markets in general. Also, money is hanging out, precious metals. Maybe you've bought some gold or some silver lately, physical gold or silver. Maybe you've invested in a gold or silver ETF or precious metal ETF. And so that is where some money is. And also money market, since you can finally get a decent interest rate on money market, we have seen a lot of money kind of hanging out on the sideline. We also have what's going on with the banking sector and the failure of Silicon Valley Bank, Signature Bank, First Republic Bank. And so that's only kind of adding fuel to the fire and creating additional negative sentiment. Basically, the level of sentiment right now is back where it was among the great financial crisis in 2008. Now, there is some good news to all of this. They say, the darkest of the night is right before the dawn, and I think that couldn't be truer for the stock market in many cases. But all of this negative sentiment is actually considered to be a contrarian positive. And I think Warren Buffett said it best, and I use this quote all the time. When others are greedy, be fearful. And when others are being fearful, be greedy. And when things look really bleak in the market, quite often, that is when things are just about to turn around. Okay, and I want to give you some stats on this. So there have been 11 rate hike cycles since 1970. And in the year following each of them, the market has gone up an average of 14.8%. More simply put, I'll say it another way. If the Fed is in fact done raising rates, history suggests that the market will climb about 15% over the next 12 months. Another historical finding suggests that when sentiment is this low, the market rises an average of 22%, and it does so 94% of the time. All right. So remember, the stock market is always a very forward-looking machine, and it can pivot very quickly. It's looking at not necessarily what's happening today, but what it anticipates will happen in the future. So in closing, if you're an investor and you've got money in the stock market, there's a good chance that you're seeing continued volatility in your account. Your friend's account probably looks the same. And just keep in mind, things could shift very quickly if the Fed does in fact follow through with, the tapering of these interest rates and eventually lowering. Now, historically speaking, the market is positioned for a big rebound, but if you don't have the patience, there are ways to stay fully invested while maintaining a defensive posture against another potential decline or even a potential recession. So if you have questions about your unique circumstances, you need help planning for retirement or some other major life event, please don't hesitate to contact me. You can simply book an appointment on my calendar, or you can email me or give me a phone call, and all that information is on my website and in this newsletter. Thank you so much for watching, and until next time, may you be richly blessed to be a blessing.